Let's get to Kevin Green, who joins me for a snapshot across some of the other stories that we are tracking this morning. We've just got some S&P Global Manufacturing PMI data hitting the tape. What are you seeing there, KG? Good morning to you.
Good morning, Sam. Yeah, we are actually seeing not only S&P Global Manufacturing PMIs, but also ISM. So for the S&P side, we actually did see that coming in at 52.5, so an expansionary territory. She was looking for 52.2, and that's a little bit better than what we saw for last month at 52.5, 52.2 as well here. You are seeing, new orders for the most part domestically, still kind of inching to the upside here, and prices potentially actually leveling off when you're looking at input prices. For the ISM manufacturing PMI, that actually did come in lighter than the street's expectations when you're looking at the headline. That came in at 48.7. Street was looking for 49.4, so obviously in contractionary territory. That has been the trend for the manufacturing sector here for the last year and a half, almost 2 years or so. But a bright spot is actually prices. The prices component came in at 58 even. Street was looking for 62.4. The previous print 61.9. So you are seeing prices maybe decelerating. They're still increasing, but decelerating for these manufacturers as a whole. Employment came in a little bit better than the street's expectations at 46. That's still in contractionary territory. And manufacturing new orders also came in contractionary territory at 49.4. So, manufacturing is only around 30% of the economy overall, but I would say this is a mixed report. And I think the market, for the most part, is really maybe not minding this one so much as the ISM services one has a little bit more of an impact that will come out on Wednesday.
Yeah, certainly a bigger weighting as far as the overall economy is concerned. But as you say, a little bit mixed, perhaps the bright spot certainly being those prices coming off. As you say, you do want those sort of new orders to tick higher and the prices to come down. But I suppose that's some progress, at least from the previous month. Interesting, obviously, because we've had a slew of PMI numbers out regionally from Asia as well. And we did see China coming off a bit too. But I just do want to dig into what we've seen as far as the latest on the US-China. I suppose you could call it the transactional truce between the two sides. We've got the latest fact sheet out from the White House sort of suggesting that they're going to hold off on the additional tariffs for now as China sort of reinstates some of the flow of semis and export trade, or I should say easing off on the chip companies. What are you seeing there, and as far as the reaction in the market today as well? Because I'm also seeing that China's going to snap up more US wheat as well for the first time in about a year.
Yeah, you are still seeing some purchases when it comes to the grain markets over the last, let's say 3 days or so. China did double down and actually bought 4 more cargoes of soybeans outside of the 3 that were actually purchased before the meeting, which is a good sign. And then the wheat market is also catching a little bit of a bid as well because of optimism with some of those purchases. So on the agricultural front, it seems like we are systems go, at least for now. It also does appear that China is going to allow some exports of some of their own semiconductors that are utilized in U.S. automotives, to say the least. So you are seeing the automotive companies actually catching a tad bit of a bid here today. So for now, it doesn't seem like we are escalating any type of tensions at this point. It seems like we are trying to calm them down. It seems like we are seeing some follow through for now, and maybe the market's going to try to, obviously discount maybe some of that risk in the near term and really focus on other areas of the market like the Fed. So not seeing any type of major backlash at this point in time. Now, we do know that Russia is sending some counterparts over to China, maybe to try to ease some of the concerns between those two countries as we are trying to kind of ease our way in the middle of both here. So we'll see what actually happens with that later on this week. But overall, we're actually looking pretty decent when it comes to some of the commentary over the weekend regarding the U.S.-China relations.
Okay, so more of the can being sort of kicked down the road, no doubt, but at least that sort of tries to avoid any further escalation in some of the tensions that we've seen. I'm just looking at some of the reaction in the market today. For instance, the rare earth and mineral companies, all lower today. Can you sort of speak to the reaction we're seeing as far as some of the trading is concerned here?
Yeah, you are seeing the rare earths a little bit lower here. Obviously, if supplies are going to kind of loosen up, the near-term concerns might be abating, especially maybe some of the investor enthusiasm. So MP Materials down about 5.3% today. We are not starting off really great when you're looking at the broader S&P 500. We actually did just turn negative right now, seeing some aggressive selling pressure taking place. And market breadth is actually one of the worst that I've seen in a very long time. We only have maybe around 19% of the stocks right now in the S&P 500 in the green. So a little bit of a rotation, maybe some follow through from that erratic trading market that we had on Friday here. But I think for the rare earths, there was a lot of retail trading getting into those names. A lot of those companies were mid-cap or even small-cap names that transformed into mid-cap and large-cap companies pretty much overnight. And some of that profit taking also might be happening as well. So a lot when it comes to the dynamics of this U.S.-China trade and some unraveling of some of those items here. But just continue to keep your eye out on the nuclear space, the uranium trade. Seems like that could be another one that really still ramps up here over the next couple of weeks and months, just given the fact that we have those power needs. And if we are escalating with Russia, Russia is one of the bigger exporters of processed uranium. And if we get those supplies cut off, then there's probably going to be a considerable need here for domestic production.
All right, and just sticking with the energy patch, obviously a lot of attention on oil this morning off the back of OPEC Plus's decision to continue to hike, but modestly for production next month, 137,000 barrels a day, but then hitting the pause button in Q1. I've seen lots of suggestions as to why this could be the case. They're saying that it's seasonality, not politics, perhaps a bit of supply glut concerns, also to perhaps defend some of the pricing. What are you seeing out there as far as how meaningful this decision is, and then also as far as the reaction in the prices this morning, Kevin?
Yeah, I would say oil for the most part is actually holding up this morning. We did see a nice little spike when we opened up last night, but that has faded here a little bit. As you kind of talked about, OPEC is going to increase their production quotas, or their targets, if you will, by 137,000 barrels per day. That was pretty much was matching the street's expectations, and also matches what they actually implemented in October here. And it does appear that they might be pausing between January and March. Now, that's going to be a dynamic plan, so they're going to continue to meet. And obviously, the environment within the oil patch can change fairly aggressively here, but it seems like they are trying to meet some of the needs when it comes to the East Asia markets that could see disruptions because of these sanctions, but concerned about inventory levels, especially when you're looking at waterborne inventory for crude. It's at one of the highest levels that we've seen over the last year and a half or so, which has also pushed prices a little bit lower. But we are hitting a key area of support, or near area of support, around this $57, $58 level. We're a little bit off of that right now, and you'd like to see some buyers really stepping in, getting above that $65 level. If we do actually break below $56, you get concerned that we could actually go down to 45, and the chart really is still, for the most part, bearish. The demand outlook isn't that great right now, and maybe that does change once we get to the spring months here and we start seeing consumption, especially on the gasoline front, ramp higher.
Yeah, a lot of those PMI surveys also very much speak to some of that demand as well. Thank you so much, KG. I'll talk to you a little bit later, getting us across those key stories this morning for